So this is a reminder to everybody that your presentation for today will be graded according to the rubric that you find here in the screen. So just a reminder, no? So you have there the ability to convey and explain thoughts, that's 15 points. And then emphasis on important points, that's 10 points. And then quality of the slides, 10 points. You don't have to really be like super good at the slides though, but at least it should look presentable and professional. And then your voice quality, that's also important. And then staying within the time frame. So I'm actually going to set a countdown timer just so everybody will be reminded of the time. At least you can keep track. And then maximum participation, that's 5 points. So the highest possible score you can get for this activity is 50 points. So we shall now begin. For a while. Okay. So we have here, there are 6 groups. So I'm going to spin here so that we will know which group will go first. Okay, so that's group 5.
Can I share screen, ma'am?
Yes.
Excuse me, makita na ba akong screen, people? Visible na akong screen.
Timer ang
Timer ang nakita, Day.
Why? Ano? I think multiple share screen tingani ni siya.
I think naka-multiple share screen.
Yeah.
It's in view options, Jill. Kaning shared screen ba?
I think per participant ang magka-control. I'm sorry. How do we do this, guys? Nag-share screen ako, actually. Are we starting the time already?
Akong gikuan imong share.
Nana, Jel.
Okay. Okay, so.
Okay na, Jill. Nakakuha na.
Okay. Okay, 1, 2, 3, go. So good morning, everyone. So our topic for today is financial markets and institution. So what is financial market? It is any marketplace where the trading of securities, of course, including the stock market, bond market, forex, derivatives, among others. So it is vital to the smooth operation of the capitalist economies. And it creates security products that provide a return for those who have excess funds and make these funds available to those who need additional money. So what are the types of financial markets? First is the over-the-counter markets. We have the bond markets, money markets, derivative markets, forex markets. So all these types of financial markets plays a vital role in the success and strength of the economy. So now let's go to the capital allocation process. So what is capital allocation? It is a process of distributing financial resources with the purpose of enhancing the firm's long-term financial stability and value creation and providing fair returns to providers of risk capital. So in a well-functioning economy, a capital flows efficiently from those with surplus capital to those who need it. So there are three ways. The first is direct transfers. Next is indirect transfer through investment bankers. And lastly, the indirect transfer through a financial intermediary. So let me call on Eliza to further explain this.
So direct transfer is typically a transfer of money from one retirement account to another, facilitated by two financial institutions involved. And this is also called a trustee to trustee transfer. Next is an indirect transfer through investment banks. In this process, money flows from savers to borrowers through an investment bank that underwrites the issue. An underwriter acts as a facilitator for the issuance of a security. Next is the indirect transfer through a financial intermediary. In this process, money flows from savers to borrowers through an investment bank that underwrites the issue, and underwriters then sell the same securities to the savers, then pass through the investment bank. Next are the types of markets. In the types of markets, we have five. First is the physical market versus the financial market. In here, the difference between the two is that physical assets are tangible, while financial assets are intangible. Next is spot market versus future markets. A difference is that the transaction is spot, where there is an immediate buying and selling, while future markets have future contracts, delay payment and delivery. Next is money markets versus capital market. Money markets are short-term debt, while capital markets are long-term assets. Next is primary markets versus secondary market. Primary markets are where securities are created, while secondary market is where those securities are traded by investors. Next is private market versus public market. Markets refer to investment not traded on a public exchange or market, while public market, this is where its liquidity, as most publicly traded stocks are available and easily traded daily through public market exchanges. Next one is QRA.
So financial institutions, so the role of a higher level, there are nine banks. So they buy securities from the corporation and consequently resell them to the savers. Next is commercial bank. It is the banks that we usually see in our environment, like RCBC, BPI, BDO, those banks that serves a variety of savers and borrowers. So third is the financial services corporation. So this is the combination of many different financial institutions. And fourth is the credit unions, which resembles to a cooperative, whose members are supposed to be a common, to have a common fund, and it is one of the cheapest because we have only a minimum
Now let's talk about that market versus the equity market. Instruments are essentially loans that yields payment of interest to their good. to their own risk. And in that market, investors and traders buy and sell bonds. Equities are inherently riskier than debt and have a greater potential for big gains or big losses. In the equity market, investors and traders buy and sell shares of stock. Stocks or stakes in a company, purchased to profit from company dividends or the resale of the stock. Next is the retail banking versus the corporate banking. Retail banking is the division of a bank that deals directly with retail customers. Retail banks bring in customer deposits that largely enable banks to make loans to their retail and business customers. Corporate banking refers to the aspect of banking that deals with corporate customers. Commercial banks make loans that enable businesses to grow and hire people, contributing to the expansion of the company. Both types of banks offer various products and services. Next, the physical location stock exchanges. Physical location exchanges are tangible entities. It acts as a market where stock buyers connect with stock sellers. Traditionally, physical location exchanges have operated in an open outcry system, but it increasingly takes place over computer on the exchange. The market for common stocks. Next is the market for common stock. Please, next slide. Common stock is a security that represents ownership in a corporation. It yields higher rates of return long term. With common stock, if a company goes bankrupt, the common stockholders do not receive their money until the creditors, bondholders, and preferred shareholders have received their respective share. This makes sense that common stock is riskier than debt or preferred shares in the long run, as it outperforms bonds and preferred shares in the long run. Now, may I call Ria to explain types of stock market transactions?
Now let's move on to types of stock market transaction. We have secondary market. Example for this is when a shareholder sells his or her stocks to the public. Then we have the primary market. These are public companies that are directly selling their stocks or shares. And then the initial public offerings. These are private firms that are for the first time opening their stocks to the public. Then we have the stock market efficiency. Next slide. These are market price, intrinsic value, equilibrium price, and efficient market. We have to take note that when markets are efficient, investors can be very confident that investors can buy and sell stocks and be confident that they are getting good price. So in conclusion, a financial instrument market can be viewed as a process or mechanism that connects the buyers and sellers of the claims. Different financial institution serves different types of of customers, whether they want to invest, raise capital, borrow, or lend money. So in this digital era, let's take part of financial instruments. Thank you.
So that would be all for our reporting. Thank you so much, everyone, for listening to our report.
All right, thank you. Okay, quick question before we proceed to the next group. This question is for this current group. What do you think is the so I'm asking for your opinion. What do you think is the reason why the financial market is almost always equated with the stock market? Although based on your presentation, based on your readings, you probably know by now that the financial markets is composed of so many other things. But what do you think is the reason why the stock market, which is just one of the components of the financial markets, is almost always equated with financial markets? Anybody from the group may answer that.
Excuse me, ma'am, can we again repeat the question?
What do you think is the reason why the stock market is almost always equated with financial markets?
Um, okay, I will answer, ma'am. So, actually, ma'am, the stock market is just one type of financial market. It's actually in the a type of financial market. So, financial markets are made by buying and selling numerous types of financial instruments, including equities, bonds, currencies, and derivatives. So, also in stock market, ma'am, it also includes the wait, wait, we got. Also, the equities, ma'am, or the equities or the stock market, ma'am, it is a financial market that enables investors to buy and sell shares of publicly traded companies. So maybe that is why it is always related, or it is equated to stock market is equated to financial market, because somehow it it revolves around buying and selling shares of publicly traded companies po, ma'am.
Okay, thank you. Okay, group 4.
Hello, ma'am.